Hi, my name is Steiki Benveniste. I am the head of ARIES Australia Management, a strategic joint venture partnership between ARIES Management LLC and Fidante Partners. We created that partnership back in 2019 to provide Australian wholesale and retail investors access to ARIES' leading global credit capabilities and other alternative asset classes. Back in May 2020, we launched the ARIES Global Credit Income Fund. Now, if you can see on this page here, the ARIES Global Credit Income Fund is a low-duration income strategy that was designed to be dynamic and deliver yield enhancements and diversification to Australian investors' portfolios. Doing so by accessing attractive levels of current income in global liquid credit, but also relative value opportunities, and focusing on preserving capital. Now, one of the key things we think differentiate these funds to other income strategies is the fact that you get access to the ARIES global credit platform. Now, taking a closer look at that platform here, you can see that while many of us in Australia might be new to the ARIES brand, ARIES is a leading and recognized global credit and alternative asset manager that was founded back in 1997. For Australian investors, ARIES has been managing capital for sophisticated institutional investors since 2008. Now, very importantly for investors in the ARIES Global Credit Income Fund, ARIES' DNA and roots are really in credit. Back in 1997, and since then, ARIES has been a leading manager of broadly syndicated loans and corporate bonds, and then added things like direct lending capabilities and alternative credit capabilities. And today, the company manages over $200 billion of assets under management, with $150 billion of that across public and private credit. Now, what's really relevant for Australian investors in the ARIES Global Credit Income Fund is that they get access to what we think is the power of ARIES platform through its scale and integration. Scale in credit is incredibly important because it allows you to be very selective. Scale also allows you to self-originate, arrange, and manage credit across both private and public markets. Integration then allows you to share information across the platform more effectively. It allows you to enhance the flow of information that goes to your investment teams that can then make a better investment decision that lead to better investment outcomes. Now, why did we create the ARIES Global Credit Income Fund? And on this slide, you will see something that many of you are very familiar with, which is what we can call the income conundrum. The fact that we currently live in an environment of record low cash rates for Australian investors, that over the past 10 years, domestic and global bond yields have compressed significantly. And more recently, with the COVID-19 crisis, we've actually realized that dividends from banks were actually under pressure in times of stress, as banks had actually cut their dividend pays during that time. And what it results in is that a lot of Australian investors are now stretching to try and find additional income and potentially just adding more of the same risk into their portfolios to get that higher level of income. The other challenge that investors face and Australian investors face is the fact that since the 2000s, you really have seen structural changes affect markets. And they have resulted in something which is evident on that slide, which is the fact that here you have credit spreads in the high yield bond market since the year 2000. And you can really see that since the GFC, dislocations have happened more often and have been shorter. Now, that's a challenge and an opportunity at the same time, because the challenge is that as those opportunities are shorter, you have less time to reposition yourself and capture the opportunity. During the GFC, you had about 2 years to reposition yourself and capture the opportunity. In the fourth quarter of 2018, which is an extreme example, you only had 11 days. So if you are dynamic and you're able to capture those opportunities, then that's great. If you can't do that, then you face more dislocation and less opportunity to capitalize on them. With these two issues in mind, we've designed the ARIES Global Credit Income Fund, a dynamic income strategy designed for those shifting markets that is seeking to act as a yield enhancer and diversifier in Australian investors' portfolios. So the first part is that yield enhancement, and really what we're trying to do is access asset classes across global liquid credit that have high levels of current income and offer attractive relative value opportunities. And at the same time, those asset classes often display downside protection characteristics like low levels of interest rate duration and being high up in the capital structure, so senior secured position in the capital structure. The other part of the strategy, which is really important, is our focus on downside protection. And here, I believe investors in this fund can really benefit from our strong investment processes that are focused on fundamental credit selection. The fact that we can really look at the best relative value on offer across those assets, and then a very focused risk management process, which you'll see later on in the presentation, allows us, for example, to manage the expected volatility of the portfolio ex ante. So that's for the downside protection. Now, if you look at what we've said earlier about the fact that you've got more dislocation more often and the need to be nimble, this strategy will look to find the best relative value not only between asset classes, but also between industries at the issuer level, being really nimble in our ability to capture those opportunities, or seek to capture those opportunities rather, and also try to protect the portfolio from downside risk. And now the last point really I want to make, which I think is a very important point, is around diversification. Because we really see this fund as a pure play on global credit asset classes, which represent a $5 trillion opportunity set, which can really diversify the risk you already have in Australian portfolios by not having any exposure to Australian corporates, Australian real estate, or Australian banks. Now, where do we get those high levels of current income? And you can see that on the next chart here. What do you have on this chart is we're showing across various fixed income asset classes the level of yields you can get access to. The dark blue lines are the ones where this fund, the Global Credit Income Fund, will be focused, as opposed to the light blue lines, or bars, sorry, which are traditional fixed income asset classes. And immediately you can see that you have access to yields of between 3.5% and 5%, especially in broadly syndicated loans and CLO securities, which are always going to be quite a significant allocation in this portfolio. Now, on top of accessing those attractive market yields, we believe ARIES can also generate favorable allocations and preferred economics through its ability to capitalize on the convergence of the broadly syndicated loan market and corporate direct lending markets as larger middle market companies grow and effectively graduate into the liquid credit universe. So examples of these economic benefits include original issue discounts, or OIDs, and structuring fees, which can add up to several hundred basis points in some cases. Importantly, these preferred economics are fully passed on to our investors. On top of those additional economics, the fact that ARIES has been a lender to this company that is now trading in liquid markets for many, many years, the fact that ARIES often has a relationship, a long-term relationship with the private equity sponsor of that company or the owner of this company, give us additional insights, give us access to better allocation potentially on top of those economics. And all of these things, we believe, lead to a better flow of information and the fact that we can actually get a differentiated view on those companies. And I believe that is really reflected in the long-term performance of ARIES in this winning by not losing attitude. And you can really see here on those charts the fact that if you look at the gray bars, which are the default levels in the loan markets and the high yield bond markets, versus the colored bars, which represent ARIES default levels across relevant loans and high yield bond strategies, you can see that ARIES has been able to under default the broader market every year and on average by a significant margin, really showing through that downside protection and the ability to do superior credit selection. On the right-hand side in the alternative credit space, we're showing no default since inception of the strategy in 2012, and what we're showing there is minimal trading losses experienced in that strategy. And I believe this really shows ARIES' credit DNA of trying to focus on downside risk and avoiding defaults across those various asset classes. If we move to the next page, I think the other way to look at downside protection is also to think about volatility in the portfolios. Over the years, we've been able to build a proprietary database of over 15,000 individual securities that now allow us to model at each single security level an expected level of volatility. So across loans, CLOs, bonds, we can look at one security. We have a proprietary model that tells us based on the type, the asset type, the spread, the size of the issue, and other metrics, what is the expected volatility of that particular security. Now, if you think about that, you can then aggregate all of the securities at the portfolio level and have an idea of the ex-ante volatility of your portfolio. And so what we're showing on this chart here on the right-hand side is the ex-ante volatility expected in the ARIES Global Credit Income Fund, which is 0.77 times the volatility of the broadly syndicated loan market and high-yield bond market. If you were to look at this metric back in May 2020, we were sitting at around 0.5 times. As you know, we have seen the environment change significantly during that time. So this leads us to the dynamic approach in the fund. And really what we're showing on this slide is our ability to generate between 3 and 4% of current income across many different economic and market conditions. What you can also see is the dynamic approach in the fund. And if you think back to the height of the COVID crisis, BBB bonds, fixed rate BBB bonds sold off massively and probably to the same level as sub-investment grade bonds. So we saw that as an attractive relative value opportunity at the time. And you can see that reflected in the level of duration in the fund. That's almost 2 years. As this market recovered, CLO debt that was similarly rated about around BBB screened very attractive because they had floating rate and they were showing additional yield above similarly rated corporate bonds. So we moved the portfolio towards that. As they're floating rate instruments, you can see the increase of floating rate exposure in the fund increasing through time. In the sub-investment grade part of the portfolio, we did something similar. We allocated more to broadly syndicated loans because we really liked towards the end of the year the fact that they had lagged the recovery and they were offering a senior secured spread with a certain level of convexity. And convexity is just the fact that they're trading below par. Loans are floating rate instruments, so you can see the interest rate duration of the fund going to 1.2 years currently, and floating rate around 83% of the fund. Now, what's interesting is that the 1.2 years of duration, within that, you've got 0.5 years really that is coming from LIBOR floors. LIBOR floors allow a floating rate instrument like loans to actually have an asymmetric exposure to duration, meaning that the instrument is fixed rate if LIBOR falls below a certain level and turns back to being floating if LIBOR and rates go up. Now, if you look at the relative value of loans at the moment versus other asset classes, on this slide, you can really see that for very low levels of duration, you get very high levels of yield. in the loan asset classes. And if you plug in inflation or expected inflation for 2021, which is the gold line, you can see that certain asset classes like investment grade corporates basically offer negative real yield for very high levels of duration, which we find unattractive. Now, if you look at the current positioning of the fund, I will draw your attention to the quality positioning in the fund, and you can really see that focus on credit rated from single A to single B, with a positioning in the fund which is focused on having at least 50% in investment grade credit, so a quality bias in this fund. We will tend to avoid things like triple Cs or the most stressed part of the credit market. Interestingly as well, if you look at the geographic allocation of the fund is a daily liquid strategy. So our focus is going to be on the more liquid US and European markets to make sure that we're able to seek that level of liquidity. So finally, with low levels of duration at 1.2 years, a broadly diversified portfolio across issuer, industries, and geographies, we really believe that the ARIES Global Credit Income Fund can act not only as a yield enhancer to Australian investors' portfolio, but also as an effective diversifier for what investors generally already have in their portfolio, because we, in this portfolio, have no exposure to Australian corporates, Australian mortgages, or Australian banks. Thank you very much for listening today. And if you wanted to get in touch and learn more about the ARIES Global Credit Income Fund or other ARIES offering, you will see contact details popping up on the screen for you to reach out to. Thank you very much.